Today's topic is dollar value versus emerging market. So this is a chart for dollar index. When you see the dollar index, which means the dollar value to the other 6 international payment currencies. So when the dollar index go up, usually people want to buy more dollars. And then dollar index going down, which means the dollar value going down, so people want to buy other currencies. So usually the market is risky, then the dollar index go up like a dot-com bubble and financial crisis. This is a dollar index chart for 1 year. So recently, 2020, around March, because of a pandemic, dollar index was down and up and then going down and stable and going one more down and stable. So during that time, stock market going up because the situation was more stable. This is a chart for 10 years US note bond yield. So when people want to buy US Treasury bond, when risk is more higher, they want to buy Treasury bond. So the bond price go up, and at that time their interest going down. So when the situation is more stable and the stock market going up, then their interest going up and the bond price going down. So the 10-year note yield curve showing the last until last year, it was the 1.8 interest rate. But recently, after pandemic, it stay around 0.6, and it stay around here, which means the situation is worse than the last year, but the stable means the market also stable. This is on chart for SPY, so it means the US stock market, and then the blue line here is the IEF, 10-year Treasury bond ETF. So here again, 2020, the stock market crashed down, but bond ETF stay in the price. Little bit fluctuated, but almost same price compared to the stock market. So at that time, when you have like a SPY about the 60 to the 80% of your portfolio, and then when you have IEF around about 20% to the 40%, then in the kind of situation when stock market crash down, you can sell the IEF and then you can buy the stocks what you want at low price. See, we think about when you buy your stocks at this low price, and then now it's about at least 20% to the 100% gain, right? Likewise, the U.S. market versus U.S. Treasury bond. This one is about U.S. market versus emerging market. So when we compare this one, we need to remember 2000 we had dot-com bubble, and then the dollar index go up a lot. Or 2008 we have a financial crisis, and then dollar index go up a lot. When those crises, the Fed what they do is lower their interest rate. So so when you see here, we 2000 year 2000, after dot-com bubble, the Fed lowered the interest rate, so dollar index up and down after that. So it's around 2004, the dollar value is pretty low enough. So it's but at that time, the money was in the US, and then the interest rate is too low, so they looking for the more earning, and then that's why they go out to foreign country because their interest more higher, and then their stock market is more going upper than the US stock market. So, as you see that way, in this chart, around 2004 to 2008, even US stock market going up, but emerging market going more higher. Okay, they're making more earnings. So after that, 2008, we have financial crisis. So US market going down, but at that time when the crisis happens, then the dollar index go up, and then because everybody want to have a dollar. So so all dollars around the world come back to US. So at that time, US market going down, but emerging market going down further. So that happens. So this time, the US dollar gonna be the dollar index gonna be stable, or maybe more chance to going down. Then the money going to foreign country, which one is usually emerging market, and then they gonna looking for the more earnings. People say high risk, high return, but my case, the control the risk and high return. That's what I want to do. So in case of a dollar index is stable or down, then I think I'm gonna do my portfolio like it in this way. Um, so when I say SPY, you can thinking like as the ETF itself, or you can go to the ETF inside. Then you can find their top 10 holdings. So I can buy one of them like individual stocks. So usually I prefer the more individual stocks. So either SPY, QQQ, or their individual stocks in the ETF, I think about 40 to 50%. And then IEF, which means the treasury bond, I'm gonna reduce the less than 5%, because when the market is stable, and then this time is the interest is so low, and then the no more cannot going down anymore. In the case stock price is stay there, or maybe very slowly increase or very slowly down, either one. So it's not very attractive. And then gold price will probably go up. So when the dollar price going down, then gold price go up further. So I'm thinking about 10% or more. And then the emerging market, you can choose one of a country, or you can find the more individual stocks in the country possible. But if you want to take a less risk, then EEM kind of ETF is safer. So in the case is 10 to 20% is I think is a maximum of your portfolio in emerging market. And then about the cash, or you can think like the innovation companies, but the small market cap. Then for example ARKK, or recently I bought cybersecurity ETF IHAK. So those kind of things is a small company, so you cannot buy one by one individual stocks. In that case, buy the ETF is I think is less risk and then more return. So it's either cash or those ETF or those stocks. I'm gonna have about 10% of my portfolio, or a little bit more, but not less than 15%. Okay. This is all about today. Love once more, thank you twice.